Hello, I'm Andy Wilson, the Sneakonomist, and welcome to another episode of the weekly sneaker recap, where I take a look at all the business and financial related news that has broken in the last week and bring it to you in a quick, succinct little chat like this. This week we have got 3 sets of corporate earnings from the space and also 2 M&A stories as well. So before I go into the details, please make sure you're following me at the Sneakonomist on Instagram, also at Full Frame Kicks on Instagram, and the YouTube channel of the same name. And make sure you've got those alerts and alarms all set, ready to go, so that you can get up to date as soon as the content drops. So I'm going to start with Footlocker. They released earnings this week, and the shares got a little bit of a pounding. They came out with their Q4 like-for-like sales. The sales dropped 2.7%, whereas the expectations were for them to rise by 4.9%. It wasn't all bad news. Their gross margin actually held up quite well. It came in at 33.1%. Consensus was looking for 30.4%. So why the disappointment? Not only were those sales slightly light, they also would not give any financial guidance for 2021. They said it's due to uncertainties around COVID. Other companies that we've heard from recently are being cautious, but they are giving some guidance. So very often when it comes to investors and investing in the stock market and in companies, an unknown is quite a big negative. If you know something or you can be cautious and price it in, then you can start to factor into the price. An unknown is probably the worst case scenario. Now, just scratching the surface slightly, it's quite interesting because they have talked about something that I mentioned back at the beginning of February. Their inventories, and this is something we've talked about a lot as well, the inventory levels have been lower. Now, what you don't want to happen is companies to have loads of inventory and not be able to sell it, especially if that inventory is in the wrong season. You have to start discounting, etc. Now, we heard from Footlocker saying that their gross margins were better, so there hasn't been discounting, but their inventories were down 26% year on year to the previous quarter. They talked about bottlenecks at ports. Now, if you go back to the beginning of February on my content, I talked some of the reasons why we are seeing bottlenecks at the ports. It's a multitude of reasons. Everybody globally has been hoovering up products, electronic products, etc., whilst we've been stuck at home. So there's been a lot of demand for products coming over from Asia. There's a shortage of the containers that go on the container ships. And you've also got staff shortages, etc., at some of the ports, and lorry drivers, etc., whether it's they've got COVID or whether they have to socially distance, and people are having to spread out more. So you've got less staff there. So these ports aren't firing on all cylinders, and that is one of the reasons why we're seeing these bottlenecks. So what Footlocker have seen is they didn't have enough of their inventories there, and you actually end up, there was demand there, but they didn't have the inventories, and you end up missing out on sales. They did say that Europe couldn't offset the decline on in-store sales. So it's something we have seen a lot of last year, but the online side of things was strong, but they particularly highlighted that they couldn't offset the declines on in-store. The shares fell 6.5% on the day of earnings. We heard from Puma as well this week. The shares actually ended flat on the week, but initially after the earnings were released, the shares fell 5%. Now, their Q4 sales were in line, and their guidance, though, was a little disappointing. You could say the company might be being a little conservative or overly cautious with their guidance. They had expected some improvement in 2021 versus 2020, but they've talked about Q1 already being hit and it probably going into Q2 as well. This is a financial Q2, not Q2 calendar. And then they're expecting the second half of their financial 2021 year to start to pick up, but it's eating into the year that people thought they were going, or at least the company thought they were going to be improving. They did walk their DTC part up, that direct to consumer, gone from 25% of sales up to 27%, so that's a nice step in the right direction, but they are behind the likes of Adidas and Nike. Interestingly for Puma, their inventories, unlike Footlocker, their inventories were up 2.5% year on year. So It's not a problem for everyone, but obviously if you're a manufacturer and you're having issues getting your stock out to your wholesalers and out to your own DTC platforms, you can be left with higher inventories. So definitely something for us to watch there. Lastly, on the earnings front, we had Crocs. Now, Crocs shares fell 7% this week. They were a clear, or have been a clear lockdown winner. They sold 18.9 million pairs of Crocs in the quarter that they were reporting. And they've had a record year of sales. The average selling price, which is called an ASP, rose 13.7% to $21.63. And they were talking, the reason the ASP was higher is because it was less promotional activity, less discounting going on. Why is that? Because they're a lockdown winner. I've talked previously as well on some of my content where Crocs are very popular in medical facilities and in hospitals. Remember, they were originally a boat shoe. They are non-slip, so if you're on shiny surfaces, etc., you're wearing these. Not only are they comfortable if you're on your feet for a long period of time, they are non-slip, except they are hideous to look at. Why would a COVID winner be getting hit? Well, in the last week or two on the stock market, we have started to see some of the big COVID winners from last year start to underperform a little bit. That's the likes of Peloton, Netflix, Amazon, etc. They've all had phenomenal runs. What people are looking at now is we're looking ahead at vaccinations that are going well. We're looking at economies reopening, shops reopening, etc. So the stuff that's done well whilst we've been stuck indoors is now potentially not doing or not going to do as well in the future. So people are starting to rotate some of their exposure they're investing in. That's why, despite Crocs coming out with record sales, the shares were under pressure. They've had a fantastic run and it was reflected in the share price. So they were kind of priced for perfection. That's it on the earnings front. I'm going to go on to M&A now, some mergers and acquisitions. And this is a name, again, that we've been talking about of late, particularly through COVID, is Birkenstock. An investment company, an investment vehicle called L. Caterton have bought a majority stake in Birkenstock. Now, this vehicle is backed by the Louis Vuitton, and they have bought this majority stake from two of the remaining or surviving relatives of the founder. There was no detail given on the financials regarding what they've paid for it, but the family that own it, they've said that this investment, this tie-up, is going to help them to strengthen in their growth markets. They're talking about China and India, particularly two countries where they want to really push things there, and also help grow their DTC and also their e-commerce businesses. So, as I said, a clear COVID winner. List that luxury platform that comes out and gives us quarterly updates on the most sought after products, etc. They have, for a number of quarters, had Birkenstock sandals in either their top 10 men's or top 10 women's must-have products. And yeah, the Birkenstock have seen the best performance in their 250-year history. So it's another similar theme that we've seen with Crocs, and also Birkenstock is comfortable sandals, slip-ons, etc. that are doing well. So more evidence of people tweaking their exposure, changing around their stable of products, etc. and brands to try and move forward after this pandemic. Lastly, and very, very quickly, Moncler. We heard a few months ago that they had acquired a majority stake in Stone Island. Temasek, who's another investment vehicle, they still owned a stake after that. Well, actually this week, Moncler have announced they've acquired that additional 30% stake from Temasek for 345 million euros. They bought the original stake for 1.15 billion euros. The reasons, just to very quickly recap as to why this tie-up works. Moncler are big in Asia. Stone Island are not big in Asia. So they can definitely use the expertise of Moncler to be able to get some of their product exposed out into Asia. Moncler are big on their own retail, their own DTC and online, whereas Stone Island, a large majority of what they do is sold through wholesale partners. So again, there's a couple of areas where Moncler can definitely help Stone Island to not only broaden where they're selling, but also the platforms they're using as well. I hope you've enjoyed the update. Please do give me a shout and any DMs if you've got any questions, or put comments in the comment field, and I'll see you soon. Thanks a lot.